My name is Lena Castanos, and I will be moderating today's webinar. I will begin by introducing the Capital Pathways program. Then I will introduce myself and give the word to our guest speaker, Kara Glasheen, Business Advisor at the Capital Regions SBDC, who will introduce herself and take us through a presentation on organizing your business finances. Feel free to ask any questions through the Q&A function throughout the presentation. We will be responding to them as we go. The questions that we cannot respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will be sharing a recording and slides of this webinar afterwards. So, what is Capital Pathways? Capital Pathways is a program funded by the U.S. Treasury and SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity and hosted by the Virginia SBDC and George Mason University. We can start with the program overview, then we will go through the program eligibility and finalize with its services. Capital Pathways is a no-cost specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. Why does it matter? Being capital ready matters because those less prepared self-select out or fail applications. Early failures correlate to lack of adequate capital. Higher cost alternatives don't build long-term capacity. Only half of requested amounts reach small businesses. To put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, just 20 to 30% of those who apply for loans actually get their loans approved. Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive, hands-on experience paired with one-on-one support. Who is eligible? Very small businesses at any stage facing challenges accessing traditional financing. The services that we provide include a guided self-assessment, legal structure validation, financial skills and tools, and loan application readiness. We start with a self-assessment that pinpoints your business key gaps so we can connect you with the right tailored resources either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through more basic legal questions, and we partner with a law firm which can help you for more complex topics related to business registrations, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics including financial basics, like today's financial statement preparation and analyses, and QuickBooks trainings. Another one of our offerings includes one-on-one individual and tailored support on business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statement and tools, and loan readiness and lender prep. Finally, our loan application readiness services include both webinar and one-on-one individualized support. The webinars are on topics such as what lenders look for in loan applications, interactive mock loan interviews, and sample application analyses. We have a partnership with a lender that provides one-on-one support to those looking for capital as well. If you are interested in getting started, you can reach out through our website at virginiasbdc.com/program/capital-pathways. I will include a link in the chat for you to have that handy and make an appointment if you are interested in the program. I will also send my email in the chat so that you have it in case you would like to reach out to me instead. Now over to introductions. I will stop sharing my screen. And maybe, Kara, you don't mind sharing yours. And while Kara does this, I'll introduce myself. My name is Lena Castanos, as I mentioned, and I am today's moderator. I have a professional background in economic development, small business support, and access to finance projects domestically and internationally. I am currently both a program lead and a business advisor in the Capital Pathways program. Today's session will consist of a 90-minute presentation. Again, feel free to ask any questions throughout the presentation via the Q&A function. We will be responding to them as we go. We will also leave some room for questions in the end. The questions that we cannot respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will also be sharing our recording and slides of this webinar afterwards. Now I will give it over to Kara to introduce herself, tell us a bit about her background, and start her presentation. Thank you, Kara, for joining us.
Great. Thank you so much, Lena. As Lena said, my name is Kara Glasheen, and I am a business advisor with the Richmond capital region the Virginia capital region based in Richmond. And I've been here for about a year. Before this, I was working as a fractional CFO and a bookkeeper for primarily startup businesses. So I'm used to seeing some messy financial data. I'm used to working with some really dynamic, quickly growing companies. So today I'm excited to share some of my knowledge with you all and answer questions throughout. Of course, hopefully this is what you intended to sign up for today. This is our Financial Basics webinar. This is primarily for business owners who are already actively in business, but maybe has some work to do around financial organization, systems, bookkeeping, all of that. I'd like to start us off with this business owner meets Sarah. So Sarah hopefully represents a lot of you all in attendance today. She is a successful Richmond cleaning service owner. And she's, in a lot of ways, she has all the markers of success. She's fully booked with customers. She has an excellent service reputation, great reviews. However, some of the things related to her business financials can be a bit messy. At tax time, she's dealing with a shoebox full of mixed receipts, taking a lot of time to get her taxes in on deadline. She's unable to apply for loans that could help her business grow. And because she's unable to prove income through year-to-date income statements. She's worried about hiring, even though she thinks she might be ready because she's not sure how her business will weather slow seasons. And overall, when it comes to the financials, she is stressed and overwhelmed. So if you relate at all to Sarah, again, you're in the right place. Maybe you're at a similar stage of your business, maybe a little bit earlier, maybe a little bit later. But hopefully, no matter where you are, you'll be able to get something from our webinar today. So here is our core problem. Can think of business owners in sort of two categories. We have firefighters, which are our reactive business managers, and we have our architects. These are our more proactive business managers. If you find yourself in the firefighter category, you are fighting financial fires maybe every day, maybe every week, but it leads to scrambling at tax time. You've got missed opportunities and you're under a lot of stress. If we can shift some of these behaviors from reactive to proactive, hopefully what we can see is that you start to prevent problems, you feel prepared at any opportunity, that you're able to take these new opportunities, and you're able to make some confident decisions around how to really run your business. And so this is what we are hoping for in today's transformation. We want to move from reactive financial chaos into proactive financial control, where again, we hope that you can move from the situation of scrambling for information, making gut or instinct-based decisions, missing some of these growth opportunities into a place where you have the information you need at your fingertips. You're able to make data and finance-driven decisions, and you're in a place where if it's right for your business, you're going to be ready for growth and potentially capital funding. So specifically, our session today is broken into these 5 different learning objectives. So as Lena mentioned, we're going to have Q&A throughout. After each of these objectives, we're going to have a quick pause for Q&A. You're welcome to put your questions into the Q&A feature as we go. But again, I'll wait until the end of each of these sections to go back through those. So we will start off with really the basis of our financial structure, and that's how to separate your personal and your business finances. From there, we'll talk about what basic bookkeeping can look like, sort of different stages of what that might look like depending on your business. Then we're going to talk about some additional systems that can be used to track your revenue, expenses, and receipts that might be outside of your regular bookkeeping practice. And then we're going to dive a little bit into financial reports and talk about how we can use these in planning and monitoring our business and our growth. We're not going to go into a whole lot of depth on the financial reports because we've got a whole separate webinar that I'll share again, the link to register at the end that goes into greater depth on that subject. And then for the last part, we're going to talk about how to set some goals and maybe do a little bit of cash flow forecasting. So these aren't just concepts. Hopefully going through all of this, you'll leave here with some tools and actual steps to take. Now, getting into the costs. So again, when we are reactive in our financial management, when we're that firefighter, I wanted to provide some examples of what we might see. So these are based in reality, of course, taken all the details out, but we can see a truck driver applying for an equipment loan, unable to get that loan because they couldn't prove income. We have a restaurant owner having to pay thousands of dollars extra at tax time to have a CPA go through their financials and be able to submit to the IRS. We have a consultant who's missed thousands of dollars in legitimate business deductions, an online retailer ineligible for grants and grant programs because their taxes just aren't up to date. We have a contractor unable to prove pricing decisions or making the wrong pricing decisions and losing out on profit. And this is a really big one and something I see more often than you might expect. When it comes time for people where they might be ready to sell their business, maybe retire, it can be really hard to find a buyer to able to get financing if you don't have good financial records. So in this example, this business owner had to reduce the sale price of their company because the buyer couldn't get financing. Now, on the other end, when we're proactive, we're unlocking opportunities, such as here with this food truck example with organized finances, knowing that they're ready to grow, ready to expand into a brick and mortar, able to get that $85,000 expansion loan in just 3 months. We have a contractor able to adjust their pricing, increase their profits, a consultant able to build cash reserves and not be so stressed out during slow seasons. And we have a photographer able to pay estimated quarterly taxes and no longer having to worry about that massive April tax bill. So now we are jumping into our first primary learning objective. And again, that is how to separate our business and our personal finances. Everything will be framed in this reactive, proactive sort of dichotomy. But when we're reactive with the separation, we see mixed accounts everywhere, your business accounts and your personal accounts kind of bleeding into each other. We see this as a risk to your personal and your professional liability. You look less credible, and it's complicated at tax time. When you're proactive, we have this better professional image, we have legal protection, and it's easier to comply with things like IRS tax code, et cetera, and you're going to be more ready for growth opportunities. And I want to start by saying why this is so important. The first point is this is about legal protection. When you mix your business and your personal financials, you're running the risk of doing what's called piercing the corporate veil. And that means that figurative separation between you as a person and your business as an entity gets blurred. And should your business be found liable for something or another, your personal assets can be at risk. Additionally, when it comes to taxes, Virginia and state taxes are complicated, and having clean records are just going to help a ton. And this is the last thing we want to happen, but should your business be audited, if you have commingled accounts and you don't have that good clear separation in the defense that you're sharing, it can result in denied deductions and higher tax bills. And again, this comes down to professional credibility and decision clarity, where if we're doing this, it can eliminate a huge amount of the confusion in our business financials. So I wanted to start first with what is an actual business expense. I talk to a lot of business owners who have trouble deciding what is business versus what is personal. And this is typically referred to as the ordinary and necessary test, meaning asking yourself, is the expense an ordinary and necessary part of doing business? So providing some specific examples. I'm not going to read through these right now, but these are some typical business expenses that all of them should directly relate to running your business or generating income. And if we think about personal expenses, these might include some common ones that I see here shared with me from business owners, include things like personal meals. So if you as a single business owner purchasing lunch while you're working, that can be really hard to define as a business expense. Things like gym memberships and fitness expenses, hair appointments, personal care, personal clothing, unless, again, this is uniform or branded, and the list goes on. The question here is, would you buy it if you were not in business, if you did not own your business? And if the answer is yes, then perhaps this is not a clearly defensible, ordinary, and necessary business expense. So simple rule, if you buy it, whether or not you own a business, it's personal, most likely. There are some exceptions, and this is where it comes to understanding your business. For example, if you are a fitness trainer, then it makes sense for you to expense your gym membership. If you're a makeup artist, it makes sense for you to expense makeup supplies. But outside of that, these can be really difficult. And if you're unclear, be sure to ask questions before you make especially expensive purchases or before claiming them on your taxes. So now getting into how do we implement this separation step by step. Typically, we start with opening a dedicated business checking account. And so this is separate from your personal accounts. It can be in your personal bank in a separate account. It can be in a new bank. There's a lot of good online bank options that have low minimums, low fees. There are also great options for entrepreneurs. From there, you might consider getting a business credit card. This builds separate credit card history, but know yourself, know your business. The last thing you want to do is run up a lot of high interest credit card debt if you're unable to pay it. So it's not required, and business debit card works fine. Really, we just want to make sure you have an easy way to spend business funds on your necessary business expenses. Next, we want to make sure your customers have a good way to pay you. So setting up that payment processing method. For some businesses, cash and check is just fine, but more and more, a lot of businesses are needing to take online payments, and they can use systems like PayPal or Square. A lot of banks also have offerings for business owners to accept payments from customers. Next, we want to make sure that you're thinking about paying yourself. If you're a business owner, even as a small, maybe early business, it is important to demonstrate the professionalism of paying yourself regularly. Should you apply for a loan in the future, oftentimes this is something that's requested, is can you show proof of paying yourself, even if that's owner draws. Of course, if it makes sense for your business, getting yourself on salary and making sure that that is all properly set up. And finally, we want to make sure that automatic payments and subscriptions are up to date with funds coming out of the appropriate accounts, whether it's business or personal. And lastly, we want to see, here's some common separation mistakes. I've mentioned this a little bit, but I see folks that are using personal accounts for their business expenses, and maybe it starts off as just this once, but especially once we link credit cards, we're doing it, it starts to happen more and more. And then it can become really hard to go back in time and track down these true business expenses just because they weren't put in the right place on the right account. I also see folks paying personal expenses with business cards or business accounts, maybe by accident, maybe because they thought it was a legitimate business expense. All kinds of reasons, but I see it happen fairly often. And I also see folks either not taking owner draws and then taking a big one, or just taking random amounts, and they're not documenting it. So they don't have a way to say quickly, this is how much I've paid myself for my business this year. Also, when we have, because with credit cards especially, it's really easy to set up reoccurring payments. And if you don't go back and check where those are, those mistakes can build up over time. And then it's just missing other legitimate business reimbursements. So things like mileage, things that could help reduce your taxable income missed over time. As a quick bonus tip, when it comes to tracking owner draws, it doesn't have to be anything too complicated. It can be a simple spreadsheet with a memo. Basically, it can be in the format of owner's draw, your name, the date. And in QuickBooks, it should be categorized under the equity section, because owner draws, unlike salary, these are not considered an operating expense of your business. These are like I said, they're equity related, so we shouldn't see them impacting your income statement. So we want to make sure that you're dealing with that appropriately on QuickBooks. So that is our first pause. And as a quick disclaimer before I get into any specific questions, I cannot provide business-specific tax advice on this call, but happy to take general questions. So, Lena.
Yes, so we have one here. How do I convince my partner to stop using business debit card for personal expenses? I record them as owner draws, but they are not consistent.
Ooh. Okay, so I would share some of the warnings that I shared in this, that this is creating the potential conflict that is piercing the corporate veil there, that your partner is potentially leaving your business more vulnerable for your personal assets liable. So we want to make sure that they are aware of the risks that they're taking. Also, it's a pain for you to make, because you have to have those additional conversations about, is this a business expense? Was this a personal expense? It should be taking time. And if the two of you ever have the plans to outsource your bookkeeping, this is going to be a lot more clear for any bookkeepers to have them not have to deal with them and not have to mark them as owner draws. So when I've helped supported people in their QuickBooks, and that I see this sort of personal expense behavior, one thing I'll do is I'll make a sub account in QuickBooks, as instead of just regular owner's draws, I would have owner's draws personal expense. And then I'm putting all of those personal expenses on that one, just to bring attention to the business owner of like, wow, look at how much you have been using that business card for your personal expenses. Like, we need to cut that out. That is a temporary solution, but I wish you luck. And it sounds like you are doing your best to do the right thing. This is the fun of running a business with another person.
What is the difference between an owner draw and paying yourself?
Sure. So paying yourself is just a general term. I'm assuming you are the owner of your business. So you can pay yourself through, most typically, if we're talking about you being an LLC, through two means, and that's through owner draws. And owner draws are literally, you are transferring money from your business account into your personal account. When you do this, your business is not paying for any of your federal or state taxes. There's no tax withholding. There's no payroll. It's a much simpler process. It's great for businesses earlier on because you can be more flexible if needed, if you don't have the cash. And it's, again, but as your business matures, you're going to be more interested in putting yourself on salary, because when you put yourself on salary, that salary is now a deductible business expense. And any additional profits you take on top of that are called owner distributions. In order to do that appropriately, you need to elect to file your taxes as an S corp. Now, that doesn't change your business entity. You're still an LLC, but you have to go through this extra step. And the reason folks do this is because it saves you money at tax time. You'll overall, if you're at a certain threshold, you'll pay less in taxes. I don't recommend this until you know your business cash is stable and you're generating at least 60K or more in profit. But if you have questions about this, I definitely recommend talking in more detail with an advisor or an accountant CPA.
Can you please clarify more about owner draw and differentiate between labeling as equity on QuickBooks for income statement versus expense on taxes?
Yeah, so when it comes to taxes, if you are an LLC and you have not elected to be taxed as an S corp, you are being taxed on your business's net income. Period. It doesn't matter if you say your business profited $10,000, but you only took $5,000 out of the business and put it in your personal account. That doesn't matter. You are taxed on that 10,000. So when you take those, the reason why it's important to label them as an equity transaction, as an owner's draw, instead of as an operating expense of your business, it's because it has no bearing on your tax filing. I know this is a complicated topic and I don't want to spend too long here. The upcoming webinar tomorrow, QuickBooks 201, we'll talk about the specifics, I'm sure, of how to handle some of these things in QuickBooks. But again, happy to go into more depth there,
Thank you.
maybe offline.
How do you create consistent distributions when I'm commission based in my income and my income varies month to month? I cover basic recurrent rent and software, etc., but I draw different amounts monthly.
So you do what you do what makes sense for your business. If this is impossible, then I'd say at least having a system of a percentage of revenue can help. You want it to make sense for your business. If this is a part-time business too, you act a little bit differently if you're full-time. Otherwise, we'd want to be planning several months ahead. So maybe you're looking ahead and you know that you've got slower months. Again, this is ideal. We want to be working towards more consistent distributions or draws. If that's not a reality for where you are right now, you do your best.
Is there a formula for determining how much to take as an owner draw?
So there's quite a few different methods on determining this. Some folks take a percentage of revenue off the top. This is the profit first mentality. There's other folks who want to make sure that you have at least 3 months of operating expenses in your bank account at any time, and that's like your minimum operating cash. And then you try to figure out how much can your business afford to maintain that. I recommend doing some cash flow forecasting to see what makes most sense for your business.
I use cash for my personal account to purchase supplies for my new business because the funds are not in my business account. How can I record this?
So for now, I'd say keep really good notes, keep those receipts, keep a spreadsheet. We want to make sure we've got the dates, the information there. And then once you start using an accounting software, if that's where you're going, then this is basically recorded as an owner investment. So instead of the money coming out of a business account, the money is coming out of this equity account called owner investment. Um, if you're having trouble with the specifics, the accounting specifics, again, just taking good notes, having that spreadsheet saying, these are the dates, these are the expenses I paid for, this is the amount that, and this, by the way, again, counts as that owner percentage or owner investment.
Perfect. What percentage of profit should I pay myself? Right.
So that is a whole set of theory. And again, I really recommend we do some cash flow forecasting because it depends on your business. Um, and I think probably not time today to go into that in great depth. So I'd say if you're being conservative, you start with a percentage and see if you can maintain that. And if you see your cash is growing and growing and growing, then congratulations, you can up that percentage maybe month over month. So there's definitely ways to play with it, but it all starts with good tracking. So that's where we want to be today. All right. So now on to basic bookkeeping. Now that your money is separated, we want to talk about tracking it smart. So this is going to be related to some of the questions that came up. But again, separating into what is reactive, what is proactive. Reactive is folks saying, I'm going to worry about this at tax time, letting the year roll, and come March, figuring it all out for the past year. That is stressful. There are errors. You're probably going to miss some stuff. And it's really hard to remember exactly what you spent on Amazon 13 months ago, for example. So a lot of times you end up paying somebody else to fix your mistakes. If you're proactive, you're tracking your expenses weekly, monthly basis. You know where you are, you can make better decisions. You're going to be more ready for opportunities. So bookkeeping doesn't look like one thing for all businesses. There's less sophisticated to more sophisticated levels displayed here. And then I want to say really the right side of the slide, it can keep going level 6, 7, 8, 9, 10, 20 until you're a publicly traded company. They're going to be having a lot more complicated bookkeeping than you guys do. But at the beginning is level 1 is basically you're running your business off your bank balance. I see a lot of folks do this starting out. Check the balance. You're like, all right, I've got cash in there. Cool. I can buy more inventory. This is risky, of course, because timing doesn't always work on your bank account. You're risking overdraws. You're not making really well-informed decisions. So we want to move from there. Second, I might see some loose tracking of revenue or expenses, maybe in a notebook. Accounting existed before people were using computers, so I don't want to knock the possibility of using pen and paper to document this, but we have these new tools at our disposal. So I do recommend moving to level 3, which is really today's focus, detailed spreadsheets with categories. So I actually think that if you're a brand new business, it can be good to start here and not jumping ahead to using QuickBooks too quickly, because it's going to allow you to understand your revenue, understand your expenses. It's going to take more time, but it can also work on a longer term basis if you have a relatively low number of transactions, if you have a simple business model, meaning only a couple types of revenue that you're tracking, and you don't have too many accounts. You don't have credit cards, you don't have loans. From there, it can get more advanced. So there's some free and basic accounting software that is out there that you can absolutely use if you're not quite ready to use a software like QuickBooks or Xero or NetSuite, and there's a bunch out there. So QuickBooks is covered in upcoming webinars. Tomorrow, actually, there's QuickBooks 201. So if you're already using QuickBooks, definitely recommend you check that one out. But using this more sophisticated bookkeeping, I recommend when you have a lot of transactions, like it's going to be just a whole lot for you to be tracking manually day to day. If you have a more complicated business model, different types of revenue, and if you're maybe managing several accounts or credit cards or loans, all of this is where having those automated tools can make a big difference. If you're just starting out, again, we're talking mainly about that level 3 tracking, where you might be curious about, okay, how do I start accounting? These are the things we want to make sure we're tracking. We want to be looking at when the cash is coming in and out of our account. We want to make sure we're recording your customer or your vendor, customer for income, vendor for expenses, the amount, the appropriate category, maybe a little description, and some payment methods or accounts. Now I'm going to go into some examples here. So this is just laying out the information generally that we want to collect. When we talk about expenses and common expense categories, here's a short list. Again, this is going to be different for every business owner as related to your business, but here's some common ones that we see a lot. Cost of goods sold, those are those direct costs that you can easily track associated with making your product or providing your service. Some businesses won't have cost of goods sold that they can easily track, and that's okay. Some of the more generic categories include office supplies and equipment, marketing and advertising, travel and vehicle, professional services. You've got the list. And then again, owner's draws, I'm going to say, again, I recommend tracking these separately because these are a non-operating expense. They do not appear on your income statement. So we'll get into more examples on how to do that in particular. Also, when you get this file, you'll have access to these two Google documents here. And this is just a sample template that you'll be able to check out. I do want to say there are so many different options out there when it comes to spreadsheets and tracking. So if you don't like the one that I've put together, that's okay. You can make your own. You can find a different one online. But what this one will have is a revenue tracking sheet, an expense tracking sheet, an owner's draw sheet, and some monthly summary with formulas. So we're going to go through this. If you do want to use this, you're welcome to click on these links, download it, check it out, use it, don't use it, get inspired. We'll go from there. So first, when it comes to revenue tracking, step one is to look at your business and define your relevant revenue categories. So for some businesses, it's okay to say you just have sales, right? We're going to assume that you're generating cash through fairly homogeneous ways, that it's going to be, there's no big benefit to you splitting it out. But for a lot of businesses, you might have two or more different types of revenue categories that I might want to track. In this example, in my hypothetical business, I'm an accountant, so I might have monthly fixed price bookkeeping services, but I might also offer some hourly consulting. And it's going to be helpful for me to track what is bookkeeping on that fixed basis versus what is my hourly consulting. So I might want to split those two things. But for anything, I want to make sure I have the date, I've got the customer, the amount. Can also be helpful to have the payment method, check, cash, Stripe, whatever it is, and a quick description. Tracking can look a little bit more complicated, but we want to make sure we have at least this information. Again, we're starting by whether you're using a spreadsheet or you're using QuickBooks or a cheaper free version. We want to make sure that it's set up properly so that you've spent some time thinking about those categories that you have set up. And a lot of the time, simple is going to be better, but this is going to be dependent on your business. In this example, I'm providing some pretty large groupings. You can see I'm looking at taxes, licenses, and registrations. When I say taxes here, I'm only talking about local tax, probably because this is what a LLC will pay and will be on the income statement, because again, LLCs are pass-through entities and federal and state taxes are paid on your personal return. But there's a total aside there. Software dues and subscriptions, so again, that's another big category, and office supplies and equipment, another big category. On the sheet that I've shared as an example, again, I'm tracking those owner draws separately on a different tab. I don't need as much information, date, amount, and maybe some notes. And I forgot to mention, I do highly recommend saving receipts. And this sheet comes with a reminder to say, hey, I have done that, with a little checkbox. The benefits of using a software is that you can a lot of times have the receipts uploaded in the software, can keep everything tidy and in one place. There's plenty of ways to go about it. Now, the sheet I shared, it also has a monthly summary. This is so we can look back after we've gathered all of our revenue, all of our expenses, that we can say, okay, what is this on a monthly basis? How did I do in January? So here we have revenue, costs of goods sold, gross profit, operating expenses, and net income. If you're unfamiliar with some of these terms, I also wanted to share some of the formulas I used in this spreadsheet. Most of it is basic sums. So equals, sums, parentheses. The most complicated formulas I am using are these sum ifs, and they can be really ugly, but basically these formulas are adding up numbers that meet certain conditions. So for this, it's adding up the revenue if it's in a particular month. Again, can spend some time if you're trying to enhance your Excel skills there. Otherwise, just know that's as complicated as it gets here. But these formulas here, so when we talk about gross profit, that is revenue minus cost of goods sold. We talk about operating expenses. That's all of your expenses, excluding your COGS, and then your net income is just your gross margin, your gross profit, minus your operating expenses. So that is the money that is left. This is likely going to be what you are taxed on. And then we have your change in cash, where we're also on the spreadsheet calculating your starting cash, the change in cash over the period due to operations, and also your non-operating expenses, and then your ending cash. So this is a little challenge question, because if you do the math, if you look at this, it might look like my math is wrong here. That if net income was 331, how come I'm only seeing a change in cash of 131? Or sorry, 181. I'm going to pause there. I'm not going to make anyone answer because we're live, but what is causing this here is that there were non-operating activities going on, and that is spending personal funds, which is an owner investment, and taking owner draws. So those two things there have affected our change in cash. So that's where it can get a little bit complicated. Now we're going to talk about monthly reconciliation. Now this sounds complicated, but it's something that I want all business owners to be aware of at the very least as soon as possible. What is reconciliation? It is basically tracking, making sure that what you have tracked matches your bank statements. So if you are, based on the process just shown, you should be able to calculate what your ending cash should be. That should be the sum of the cash in all your business accounts. And if you caught everything, if you documented all of your expenses and all of your revenue appropriately, then your calculated cash at the end of the month should match your bank statement at the end of the month. So this should be done on a monthly basis to make sure we're catching mistakes, we're catching errors. Part of the process is typically downloading your bank and credit card statements. This is also a great practice to have your bank and credit card statements downloaded, because not all banks will allow you to access these statements forever. Some are only make them available for a year or two or something like that, and it can just be a good backup to have. You want to check every transaction against your tracking. You want to find those differences and fix them. And you can check this in the spreadsheet. You can check this in Excel, or in QuickBooks or an accounting platform. Every accounting platform has reconciliation, and it's most often the step I see missed. So common reasons that it can be off is maybe you forgot to record some minor fees like bank fees. Maybe it's a timing thing. Maybe there were some automatic payments that you didn't include in your tracker. Or maybe you were moving money between different accounts, like between a savings and a checking, and that caused some confusion in what was actually going in and out. Again, this matters because this is a step that makes sure your data is clean, your reports are reliable, and can help you make these confident decisions. This is getting a bit more advanced, but I've got to mention it. I'm happy to talk to folks afterwards about offline about what this means based on where you are right now. So putting this all together, this is part one of some time-saving systems I'm highly recommending. We're going to update this throughout the presentation, but how you can adapt this for your business is through these weekly, monthly, and quarterly actions. So on a weekly basis, no matter how you're tracking your revenue and your expenses, whether it's a spreadsheet, whether you're using QuickBooks or a cheaper alternative, making sure that you're going in and just making sure it's up to date, looks right, you understand all the expenses, all the income. I recommend just picking a day and time and sticking to it. Once you're in a good flow, it should only take about 15 minutes to track your revenue and expenses. Monthly, I recommend going back and reconciling your tracker with your bank accounts. Are you adding up to the same cash? Make sure you're not missing anything. And then quarterly, spending a little time to make sure that your system is working properly for your business. Do your revenue and expense categories make sense? By doing this regularly and a little bit, it's going to be way less stressful than trying to do this all at once at tax time or at the beginning of the year. So now we're ready for some more questions.
Yes, of course. Is it frowned upon, or is there a suggested way to pay someone who is family? For example, if your child is building your website for you.
So the most official way is you want to treat even these family members as employees, right? They're not, your child isn't an owner of your business. Ideally, you should, if possible, we'd want to put them on payroll, or we'd want to actually pay them if it's gonna be regular, put them as an employee. If they're just building your website for you once, maybe you want to call them a 1099 contractor. I don't know. Then they're basically almost operating their own business. What I want to encourage folks to avoid is if you start paying family members, children, just straight out of your bank account, that is not going to be and you are like an LLC, you take owner draws. If that cash is just going from your business account into their account, what we want to be careful of is that we are either considering them a contractor or an employee. If you're not doing either, then in the eyes of the IRS, you're basically paying them under the table, and it's not a deductible business expense because that cash is just almost like paying them out of your income as the owner. So definitely I recommend exploring how to make sure that this payment is either treated as a contractor payment, then they're essentially like a 1099 contractor, which means at the end of the year, they should be filing their own taxes, because if you end up paying them more than $600 in a year by cash. So it can get complicated. I think a lot of people start in a very innocent way paying family members. And if you end up paying your family members a lot of money, it can have some significant impacts on your business. So I will warn you. And again, something we can talk about that you can talk about with an advisor in more detail.
What is an example of free basic accounting and financial software?
So one I recommend a lot is Wave app, is Wave. It's waveapp.com. They have a free version, which is nice. I will say their free version, you can't do things like link your bank account, but at a free version, you can at least go in there and try to set it up, and see if you're able to make it work for you. You have the options to manually track your revenue and expenses, or to import CSV or QuickBooks files that you can download from your bank account. I know that sounds really complicated, but there's tutorials online on how to do that. There's also FreshBooks, there's Quicken, there's some that I keep hearing about that I'm not familiar with, that you can find online. But again, I do recommend Wave fairly often. It works it works well for some folks.
And an example of a more sophisticated software.
Sure. So QuickBooks, I'd say, can get very sophisticated, and it also comes with tiers. So most of you are going to be using probably like the standard QuickBooks subscription. So that goes up and up into advanced, where you can do a lot more things. It unlocks a lot more features. NetSuite is something I see a lot of bigger businesses use, startups, scaling businesses use. I'm not as familiar with that myself. Um, so you can do a lot with different types of softwares.
An accountant recommended Quicken instead of QuickBooks as it is cheaper. It is intended for personal finances, but works for me. Is there a drawback to that?
So I've heard people recommend Quicken. I have not personally used Quicken myself. And like you said, it is intended for personal finances, but it can work well if you're really truly like a sole proprietor. You are maybe somebody who offers a contracting service, and you're just trying to track some basic income and expenses. It can work. I think the questions you should be asking is, do I know how to get the information out of this that I need, either to make business decisions or to file taxes? You're going to be missing some features, but like I said, it's existed. So again, it's about whether or not it's giving you what you need.
Wonderful. Is it okay to pay yourself quarterly?
Sure. So I like the idea of monthly payments, but that is purely a suggestion because that's how a lot of us are used to getting paid. But if quarterly is nice and steady and that works for your own financial situations, yeah, no reason to force yourself to stretch it out.
What is one of the best softwares you recommend for bookkeeping that can be used free of charge? I think you mentioned Wave App.
Wave app is really the only one that I've seen that I like and I'm familiar with.
Where can I find forms for tracking and paying a contractor?
So I think just a simple spreadsheet would work. I'm not sure exactly what you need, um, because really, when it comes to paying a contractor, I don't know if this is part of your question. We want to make sure that you ask for their W-9 and you have their W-9 on file, and then if you're in if you're in QuickBooks, you document those payments through your accounting software or whatever you're using. Otherwise, I'm I'm not sure, and you can reach out if you have a more specific question that I can work with. It's yeah.
Um, I am currently using a spreadsheet to track expenses and I save all receipts. I want to know that I am following the rules when it comes to filing taxes as an entrepreneur. Can I go to a regular tax place to file for my business? Do business owners file a different date than April 15th date?
So I love to hear it. You're saving all your receipts. I think you are not the typical business owner that I speak with. So yeah, I like I said, that's great, a great practice, and it really protects you in the case of an audit. Um, Now, I'd say most tax places will work with you. I'm assuming you are an LLC. I don't know. And so LLCs have that April 15th date. You can also file for an extension. But again, if you file for an extension, you can still, and you owe money, I think interest can still be accumulating. So better off to file on time. But if you had a corporation, if you had an S corp or a C corp, you have a different filing date, but I doubt that applies here. Also, we're talking about quarterly tax payments. It is recommended for business owners, if you think you're going to owe more than $1,000 in taxes, that you should be paying quarterly if possible. Um, but at least paying on time might get you a good start.
Wonderful. If we have made personal loans to our business, how do we appropriately account for returning that payment?
So a lot of this depends. If to make an official personal loan to your business, you should have paperwork that tracks this. It should say, this is a loan, these are the terms, these are the interest rates. If you didn't do that, then really most folks are going to look at the money that you lent to your business as an owner investment, and there's no paperwork. You would track it and you would pay yourself back through owner draws. This is the simplest way. Again, maybe different situations are going to be different. So
Um, are there any bookkeepers that you recommend who are local in the Richmond area?
So we've got a few. It is hard to keep up with because every time we find a good one, they're not taking that many clients. They take a few clients and they're not taking any more. The best sources I have found is the Metropolitan Business League. They do a really good job of staying on top of who are good service providers in the greater Richmond area. Um, like I said, it is tough to stay on top of. So when I find a good one, otherwise I highly recommend looking at your chamber directories. So like Chesterfield, Powhatan, Richmond, you can go on their chamber website, look up their chamber directories. You'll find a good list of accountants and CPAs. I don't love to recommend bookkeepers unless I have at least one or two positive reviews, and I don't get to work with all that many bookkeepers directly. So unfortunately, I recommend having to do a bit of research to vet these folks.
I am paying a handyman to assist with business at least once per month. It's over $600 per year. How should this be handled?
Okay, so the handyman, technically, they should be considered their own business, assuming you're paying them cash or check. You want to check and you want to look up 1099s, filing 1099s. I'm assuming that's what you're going to need to do. Again, I'm not a tax advisor, so I want to be careful not to give too specific tax advice. But the general process for dealing with contractors is when you initiate that relationship, or at least in advance of tax time, you get their W-9 on file. It's a tax form. They fill out their information. And then come the end of the year, you would submit a form to the IRS saying, this is how much I paid this contractor over the course of the year. And this is how the IRS then taxes them. So, yeah, talk to more folks about that. But the key search terms there are 1099 filing, W-9, contractor, things like that. All right.
Thanks,
So
Tara.
I love the questions. I hope it doesn't put us too far over time. We're going to do our best. I can see the clock. All right, we've got about 30 minutes left. So some of these next sections are a little bit less dense. So talking about some additional systems to track revenue, expenses, and receipts. Again, we want to move into proactive capture instead of just this reactive scrambling that a lot of business owners find themselves in. So unfortunately, this is going to be something very specific to you and your business and the type of industry you're in. So there are a ton of tools out there. It seems like more tools go on the market every day. And depending on where you're operating, you're going to have different needs. So for example, if you're a retail or product sales, there's things like, excuse me, Etsy, Shopify, Square. Some of these are point of sales systems, making sure that you have the tools to give customers a good way to pay you. If you're in restaurants or food industry, we see a lot of folks use Toast or Square. There's Clover. There's also some really great, more local companies that can work with you to design custom point of sale systems that work online and across different platforms. There's service, if you're in a service business, you might care most about booking appointments. So using something that can help you book and help you manage that customer flow might be really helpful. And this can also provide great information as you're looking back, because you might be able to see things like the number of contacts you got from customers, the number of actual appointments you had with customers. So as you're evaluating these different tools, you should be thinking, what is the purpose of this? How will it help my business? How does it go beyond what I'm getting out of my QuickBooks or my Wave or whatever it might be? So there are again a lot of options, and for some businesses, you don't need all of these additional things. So really, if you are early stage, if you're trying to run a lean business, really question, what are the core features that are necessary, what options are out there, and it's going to take doing some research to see what's going to be best for you, both from a price and quality standard. So most payments, and keep in mind, I've had folks who they're like, well, I'm using Square. Do I really need QuickBooks? And again, yes, most payment platforms don't do full accounting, but they do integrate really nicely with accounting systems. So this is another advantage of using a QuickBooks or a Xero or more sophisticated accounting platform over something like a cheaper version, is that if you decide you need these more sophisticated custom tools, they may or may not integrate with the more affordable accounting platforms. So we want to look at this whole system as a whole. Next, expense and receipt tracking. This is about audit proofing your business. This is about what happens if. None of us want to be audited, none of us expect to be audited, but if you were to need to prove that you had a certain amount of deductible business expenses, receipts are how you're gonna be able to do that. So this is my recommendation. We want immediate capture. If you're getting paper receipts, take a photo. You can use your phone, or there's apps, or put it into a special folder. Just find a way that you make sure as soon as you're getting it, you have a method where you know where it's going. When it comes to organizing, it's again, whatever works for you. It can be a folder on your phone that's backed up to a cloud, but there's also some specific apps and different softwares that you can use that might work with some of the accounting platforms you might already be using. And then there's even fancier apps that can do things like auto categorize and integrate directly with your accounting. Like Ramp is a software that I've used that I've liked that does this. But really, this becomes necessary, I think, when you have like a lot of employees and your employees are spending money, and then you're having to not just track your receipts, but their receipts and understand, the legitimate business purpose for all of these. But also, we want to make sure we're capturing that the business purpose of any of these expenses. So quick tip is, you can write on the receipt or photo description, what is this for? What were you doing? There's some special tracking situations that might relate to that might be important for micro businesses to think about. One thing I want to mention quickly is mileage versus expense tracking. When you go to, and when you file, you can either file your mileage or your actual car vehicle expenses, but you can't file for both. So for a lot of businesses, mileage is simpler. There's ways to handle this come tax time, but tracking mileage, you're going to get a higher deduction than trying to track those individual fuel receipts and maintenance and all of that for a personal vehicle. So, or even a business vehicle. So when we're tracking mileage, you can use paper logbook, a spreadsheet, an app, and you want to make sure you're capturing the date of travel, where you're going, how far you traveled, and then you can get that full reimbursement on your taxes. Cash transactions may be relevant for your business. So if you're accepting a lot of cash, you might need a daily cash log. Again, this is going to depend on your business and what is going on. So another question I get a lot about is related to home office. There are some different ways to think about the deduction here. Do you want to calculate the percentage of your home used for business and then track all of your home expenses, your mortgage, your rent, your utilities, your insurance? Or do you just want to use the simple method, which is deducting $5 per square foot up to 300 square feet, which is $1,500 for the year? It depends. And again, you can use some pros and cons of which method makes more sense. Most folks I know use the simplified method. And then there's mixed use items. You want to make sure you're thinking about if we have items that you're using personal and business, the technical way we're supposed to do this is to calculate the percentage use that is business. And I know this can be subjective. So you want to think, all right, if I'm going to do this, how can I defend this? And for client reimbursements, tracked separately. We don't want to count money that you are reimbursing to clients, or if you have those specific types of expenses as income, or so making sure that if you have some weird things going on with your business or specific things going on with your business, we want to make sure it's documented clearly for tax purposes and for your own knowledge understanding. So taking that last sort of system slide and updating this based off of the Section 3 information, I would recommend adding these steps into your weekly checkpoints. You want to log into any revenue tracking tools you might be using. You want to make sure that your receipts are up to date, that you know where they are, you know where to find them, and that you update any specialized logs or trackers that you might be using for your business. So the rest of them stay the same. Now, on to questions.
I am a contractor operating a sole member LLC. Does it make a difference whether my income 1099s are in my TIN or SSN?
Oh, that is getting too far for me into personalized tax advice. I feel comfortable on a recorded webinar. We can maybe speak separately.
Most of these tools provide several reports, for example, transactions, sales, reservations, etc. Which one do I need to download to keep a record for income?
So with the tools mentioned, to keep a record for income, really when we're talking about having a record for income, I care most about just the cash in. So that should be your accounting software. Those tools, a lot of them are supplying additional information on top of just having a record for income. So this is really going to come to, you should download things that are useful to you. Your that help you make business decisions, that help you reflect back. Um, if you're you should be able to prove income pretty well, mostly through bank statements. People have a lot more trouble proving expenses. And again, what we want to be able to see is we want to be able to produce nice, clean financial reports upon request. So I'm not sure if I understand that question completely, but that's my shot.
This is a follow-up to the personal loan question. If I took out a personal loan to initially start my business, but I pay it out of my personal checking account, I use one vehicle for business. Can I count? Okay.
So in that situation, if you business owner got a personal loan, then that operates kind of outside the bubble of business finances. So while it makes sense to use your business draws to pay back the loan, your business wasn't involved in that loan, right? It was just you as an individual, not your LLC, not your business entity taking the loan. So that is a personal loan, not tracked. The cash that comes out of your business most likely is an owner's draw, and that's what's going to pay you, just like if you were an employee of a company. So I'd say nothing special in terms of the tracking on the business side.
I use one vehicle for business. Can I count car notes, insurance, etc., or is it better to use mileage?
Most often, for most folks, it's better to use mileage. However, if you're unsure, then worst case, you track both. And then at the end of the year, you do a quick calculation of if which gets you a bigger deduction. Work with tax folk on what'll be ideal. So that's the goal. We want to maximize deductions based on your particular situation. Now, we're going to dive a little bit into some reports. And this specifically income statements, and specifically your income statement of cash flow can show you. Again, this is going to be just a little taste. We have a much longer webinar specifically on financial statements, but in a quick overview, your financial statements basically serve like your car, your dashboard. Your car has gauges, your business needs them too. So when you're driving, your car's going to have some information. It's going to tell you, how fast am I going? Am I going too fast, too slow? Do I have enough fuel to make it to my destination? Is my engine overheating? Like, these are the same sorts of things you can look towards your financial statements to find out. So if you look at your income statement, you can see your profit. Am I making money or losing money through operations? You can look at your cash flow to find out if you're going to make it through the slow season, how much cash you have left, where has cash been going over the recent history of your business. And you can look at trends. Is your business growing, declining? What do we need to prepare for? So the key reports to monitor here, again, are your income statement and your statement of cash flow. So first, with our income statement, a quick look. This is also known as your profit and loss. I'll refer to it most often as a P&L. So just to keep it clear, profit and loss, income statement, P&L, these are all the same things. I don't know why we have these different names, but we do. So I want you to be aware of them. But this is most often thought of as the most important report for most small businesses. In simple terms, your profit and loss shows your revenue, all earned money coming in. So this is not cash that you loaned to the business. This is not specific business loans coming into the business. And it's subtracting out your operating expenses, which again is all money spent on operations. And again, owner draws are not technically an operating expense. So revenue minus operating expenses equals net income. As a quick note, sometimes you hear net income, net profit, EBITDA. These are all roughly the same, relating to the same thing, but we're going to go into more depth in the financial statement bootcamp about how those terms are different. Now, our income statement, I wanted to show an example based off of those same templates that I that are going to be available to you after this that are linked in the prior slide. This is an example of a summary income statement. So I like to look at these on a monthly basis, because when we look at it on a monthly basis instead of summed up over a year, we get a lot more information. We can see trends. We can see, revenue over month by month. Is it growing? Is it staying flat? Is there anything that looks suspicious or strange? So here, again, this is a hypothetical bookkeeping type business. And you can see early on, the revenue is going up, up, up. And it's big in April and May. Now, why might you think a bookkeeping business might have higher revenue coming in April and May? Probably because of tax time. So there's a little bit of seasonality in this business. And then it goes down to a more just consistent level across through the end of the year. Now, you can also look, this is again a summary, but if we were looking at the full profit and loss statement with all of our operating expenses split out, I'd want to look at the trends here of which expenses are growing fastest. Are my software expenses growing out of control, signing up for a new subscription every month? Are there any surprises or any big numbers that I just didn't expect to see? So here I see pretty low regular expenses, but in December, I spent a bunch of money. Why? Was this intentional? Was this a tax strategy? Was it a charitable donation, a December bonus? I don't know. We want to make sure we have a clear explanation for anything we see here. So as a business owner, you should get used to, at the very least, looking at a summarized view of this and knowing that you can confidently interpret what's going on. You can also use this to come up with some margins, so things like your profit margin, which is where you take your profit and divide it by your gross profit and divide it by the revenue. That'll give you the percent. So you can do a lot with statements like this. It's nice to have them in Excel, even if you use QuickBooks, because you can start to play around with the numbers a bit. Now, next onto cash flow. So their income statement, while that shows some great information, what's missing is a start cash and end cash. We don't actually see how much you have in your bank account anywhere on this statement. So your cash flow statement is a separate financial statement. And when we talk about your business cash flow, we're talking about, how does money move in and out of your business, whether we're talking about operating or non-operating cash. A lot of businesses have some cash flow challenges, and there's some things that we can do about it. So typically, you can run a really good business, but depending on how your customers pay you, you may really struggle with cash flow. Maybe you're technically operating a profitable business, sending out a bunch of invoices in March, but your customers don't pay until May. And so you want to make sure that you understand your timing when you're planning. So for example, if you're trying to get into government contracting, you need to be ready that the cash flow cycle, the time it takes for you to get paid, is going to dramatically slow down. So it can be 60 to 90 days. Other cash flow challenges is some folks might forget to factor in owner draw or owner distributions into their income statement. They look at their profit and they're like, that's great, but it's not actually what their goal was in terms of the revenue they wanted to generate for themselves personally. So you want to make sure that you're planning owner draws ahead of time based on expected cash flow. Next, credit card payments. If you're using credit cards, this is another tricky part, because you might not be paying attention to your credit card balance as you're building up expenses over time. And then if you're over relying on credit cards and debt without the cash flow to support those payments, you can get in real trouble. So what do we do about it? We only use credit card debt specifically for short-term assets, for when we know that we can generate the revenue, the profit, to be able to pay them off in a timely manner. If you get into trouble with credit card debt, definitely reach out to some support advisors. There's potentially options to consolidate debt, especially high interest debt, and that can be something that can really be a huge burden on a growing business if you accumulate too much of this high interest debt. And then another cash flow challenge is just that you might have some fixed expenses that occur steadily throughout the year, even though your revenue might look more like this. So if we want to make sure we're mapping out your fixed expenses and planning out your cash reserves accordingly. Now, those are our statements. Those are what we should be looking, or a taste of looking into our statements, and what we should be looking for. So we're going to get into that a bit more, but again, I do recommend adding this to your monthly check-in, looking at that monthly income statement, seeing how it changed over the prior month, and starting to pull up a statement of cash flows to see how your cash has changed and what else is affecting your cash besides revenue and expenses. All right. I think there's one more objective to go. So,
Kara, would you like to run through the, not run, but get through the presentation and then take any remaining questions?
that is a good goal. All right, let's charge ahead. We'll get to the end and we'll take them all at once. So the last part here is how to use the information we've talked about a little bit more, set some goals and forecast cash flow. And this can be casually, but our goal is to go from hoping to planning and really engage. We talked about your car dashboard. Now we're engaging your business GPS. So in a reactive business, you might say something like, wow, I really hope this year is better than last year. If you're being proactive, you might say something more like, I set these specific targets based on what I saw last year, and I feel confident I'm going to work towards them. So we're going from wishful thinking, flying blind, to evidence-based planning and measurable milestones. It also gives you the ability, if you set these targets and you're tracking them monthly, to make adjustments as you go. So if we're being proactive about goal setting, I recommend setting goals in this order. So the simplest goals to set, what you have most control over initially, probably as a business owner, is revenue targets. Even if you're a brand new business, you can look at industry data, you can look at competitive businesses, and try to come up with how much cash are you trying to generate from customers in a given period. If you're an existing business, you can look at last year, use your historical data, plan forward. Next, we want to look at your expenses. How are you managing your expenses? And do you have a budget in place that keep you controlling costs before it creeps in, starts to kill your profit? We see this happen a lot, that maybe you start off as a profitable business with lower revenue, and then your revenue grows and you get excited and all of a sudden your expenses explode. What you end up doing is killing your profit. So if you start to see this happen and expense management isn't correcting the issue, then how can we improve profit? Do we need to make pricing changes? Your expenses, if they go up as you scale, maybe your prices also need to rise. So a small pricing change can make a big profit gain. Then once you've got these things kind of tuned up, let's start thinking about that emergency fund. How do we build up enough extra cash and operate maybe 3 to 6 months of operating revenue? That's a good goal for a lot of businesses. And once we have all of these things, then we can start thinking about truly investing in growth. Know exactly when you can afford to expand, hire new employees, open a brick and mortar, whoever what it is. But from the bottom line, you can't set any of these goals with confidence until you know your numbers. So when we're thinking about cash flow forecasting, now the reactive is I'll find more cash if I run out. Proactive, I want you to be thinking at least 3 months ahead. So what does this look like? Step 1 is project your revenue, and also potentially your other revenue, other cash ins to your business. So first you take what you know you have as income. Maybe you have some contracts that you are expecting to see, and then you add to that some expected sales. Maybe you've got a pipeline of customers. You're like, I expect I can add an additional $1,000 a month in revenue. Then make sure we're thinking about some seasonal adjustments, and then also account for if you have any other non-operating cash sources coming in. That's going to give you all of your cash sources. Step 2 is to project cash out. So what are your expected operating expenses for each month across all the categories we've talked about? And what are your expected non-operating cash outs? So that's your owner draws, your loan payments, if you have any equipment purchases, anything that could be pushing cash out of the business. Credit cards, again. So if you have a clear understanding of all the cash ins, cash outs, Then you can calculate, taking your starting cash at the beginning of the month, all of your revenue in and all of your other cash in, all of your expenses out, and that'll get you to your ending cash. So what this can look like is using the spreadsheet we had available. This would be me planning this at the end of December. Maybe I'm a brand new business and I'm looking ahead towards January, February, March. I'm trying to make sure that I'm putting enough cash into the business. And starting in January, these green numbers are representing my estimates for January. So like I said, this is December. I don't have any customers in my pipeline. I don't have any customers signed up. I'm not expecting any cash in January. I'm really focusing on building that pipeline. So 0, 0, 0 down the line, I have expecting zero revenue in. But I'm also planning that I'm willing to invest $500 of my personal cash into this business. Now, I've done my due diligence. I've figured out what I expect to spend in terms of operating expenses for January. Figured out that's going to be about $340. But because it's the first month, I'm not going to take out any owner draws yet because I don't expect to have any revenue. So I can calculate my cash by taking that zero operating cash in, the $500 I am investing into my business, and subtracting out that 340 expected operating expenses to get from my starting cash to my changing cash to my ending cash. And I'm going to go through that process across all of these 3 months to see, where do I end up at the end of March? Am I comfortable with this? Is there something I can do that can course correct? This gives me the opportunity that if this number calculated is negative, then I know, well, I need to either step on sales or I need to invest more of my own personal funds into this business to give it more time to grow in the way I want it to. Another thing here is I recommend using formulas if we're using spreadsheets. So that's just a quick plug. Now, I know that this part might feel overwhelming, but this is something that an advisor can work with you in detail on, specific for your business. And I at least want to expose you to the general way we think about it. A lot of folks feel very overwhelmed by projecting their finances into the future. The more times you do it, the more comfortable you're going to get, and probably the more accurate you're going to get as well. So another quick plug that we live in Virginia, we have seasonality. So we want to plan for it. And most businesses have some sort of seasonal patterns. And other businesses, a seasonal pattern might just be your own availability. Do you take holiday off? Do you have an annual family trip? If you are the only operator in your business and you're not going to be able to generate revenue during your planned vacation time, make sure we're accounting for that as well. Now, I recommend here the action step is, if you are in business, you can take a look back at your past 12 months and you can see what were your high and low revenue months. Is it what you would expect? And you can use this to help you plan your cash reserves around your slow season so that even if revenue takes a little dip due to foreseen seasonality, you're prepared. So our growth planning, moving from there to our growth planning framework, how do we use our financial data to make growth decisions? We want to start with these pieces. If you're really trying to think about, man, I'm excited, I want to grow a team, I want to have 5 employees, I want to open up a brick and mortar, I want to do this or that. Let's make sure we have all of those fundamental pieces in a line. So I'd recommend going through a framework, something like this. Do I have a little bit of cash reserves? Do I have the ability to take a little bit of a risk here? And at this point, I recommend, if you don't have 3 months or so reserved, let's focus on building reserves before making big, expensive growth investments. Are you consistently profitable? If not, let's evaluate expenses or boost revenues. Is our revenue growing or increasing, or at least staying, constant or in an expected comfortable zone? If no, then we need to focus on some low-cost sales or marketing methods. Maybe that's literally picking up the phone and calling customers. If yes, do you have a lot of debt that you need to manage? And if you do have a lot of debt that you need to manage, then it might be time to think about paying down or consolidating debt before investing big into growth. Now, if you answer yes to all these questions, go for it. There's some smart growth investments, might include hiring employees, purchasing big equipment, marketing campaigns, location expansion. Again, if you answered yes to all of these, there's a good chance you'd be a good candidate to find outside funding, microloans, bank loans that can help you achieve some of these bigger growth moves. So this is our action plan this week. These are some things you can do. If needed, you can open a bank account, business bank account. You can start updating or set up an appropriate tracking system based on your business. You can look back at your receipts. You can block your calendar for some specific times to, dedicate to your business finances. I had a client who referred to it as her Money Mondays. I like that. But block off that time, put it on your calendar, make it a habit. And then as needed, get on the calendar with a business advisor or a mentor, maybe even another business owner who's on a similar journey to you that can help you stay on track. Now, here's our same weekly, monthly, quarterly action items that I highly recommend. Weekly, we are reviewing our tracking, we're logging into our tools, we're checking our receipts, we're updating specialized trackers. We're doing this consistently week over week over week. Monthly, we're reconciling, we're cleaning things up, we're reviewing our financial statements. And quarterly, we're going to review revenue and expense categories. Then we're going to reflect on past trends and ideally update our cash flow forecast. Now, remember Sarah from the beginning. 6 months after going through this process, so we want to be like Sarah, start with some small, simple changes that build over time. Make sure we've got those separate accounts, got that time set aside, start tracking, build up an emergency fund. What Sarah was able to do is hire her first employee, and the results are no more tax season panic, approved for loans, sleeping better at night, taking a steady salary, and able to move yourself onto a salary, making decisions based on data. And then really, I think a lot of your goals should be to have more time to work on the business, not just in the business. So that is a big goal. And this is now your turn. So start with this week's actions and build your proactive business foundation. Now, quick plug in this, I also have links to some of the upcoming webinars. Tomorrow, QuickBooks 201, October 28th, SBA loan programs. 29, you'll have me again. That is how to read and use your financial statements. And then we're cycling back around November to QuickBooks 101. So plenty of good stuff coming up. Happy to take some questions. And quick plug, however much I have time, when you exit this webinar, you're going to be asked to fill out a survey. I would love, love, love your feedback. I do look at all of it. So thank you very much.
Thank you so much, Kara, for your time. We've already gotten some good feedback. Again, we would appreciate it if you could fill out that survey. It really helps us improve our webinars and make sure that you get what you need. So one of the questions here is, our LLC has two partners. Do we take the home office expense and for each of us out of our total business expenses to be able then determine total profitability for the business?
So I'm a little unsure with the how to make sure that is complying from a CPA perspective. So I encourage talking to a CPA about making sure you're doing the deduction right. But then yes, technically speaking, all of your tax deductions should be deducted from as a profitability from your business. And this is actually a conflict I see a lot between lenders and accountants, because a lot of accountants and good CPAs, they're going to be doing the best to maximize your business deductions, which in turn decreases your profitability, because that means you pay less in taxes. That's their goal. And that makes sense that it should be your goal. But then from the lender's side, they are much more excited to lend money to businesses that show consistent profitability. So there's a little bit of a trade-off between those two things. So depending on, are you planning to apply for big loans, or are you just trying to run a good, sustainable business and minimize your tax liability? Those are going to be slightly different strategies. Talk to an advisor, talk to a CPA about how to do what's right for you.
As a single member LLC S Corp, do I set myself up as an employee for salary versus paying myself from an owner's draw?
So if you have elected to be taxed as an S corp, you should be paying yourself a salary. Yes. If you have not done, it's a form. I don't remember the name of the form, but you have until March 31st of a given tax year. So if you want to make this file for 2026, you have until March 31st, 2026 to elect to be an S corp. So this can be, you can go backwards in time up to that 3 months, but um, technically speaking, yes, these should be that you're gonna and you're gonna be getting a better bang for your buck. You're gonna decrease your taxes if you're paying yourself that salary instead of taking the draws. So
I see Dana requested a link to upcoming classes. Dana, I will send it via an answer to your question, and it will show up as in the answered box. So I'll do that after we get through these
got
questions.
got a handful of them here.
And there's a few over there as well. You should be receiving the slides after. Would a marketing expense be categorized as an operating expense?
Absolutely. Marketing expense, sales and marketing, these are some of the most common operating expenses for your business because again, asking yourself the question, did spending this money at least theoretically contribute to revenue generation of my business? If yes, it is an operating expense.
Wonderful. This has been the most useful SBDC seminar I've attended. Thank you. Very practical. Didn't just read the slides, clarified key points, provided practical information I can use immediately. I agree. Kara is so good at these. How do you handle startup expenses before you receive any revenue or have any clients?
Yeah. So most businesses out there are funded initially at the startup stage through a combination of personal investment, personal savings, family savings, and credit cards. That is the truth. I think a lot of folks think that there's startup grants or there's more startup grants out there than there truly are. They're pretty rare. Startup loans are hard to come by. It takes a lot of work to go through the process to be approved for a startup loan. That's something I work with clients with on the daily. But handling the cash, if possible, bootstrapping your business, funding off of your savings, that's the cheapest source of capital. You don't have to pay yourself interest, you don't have to take on debt liability, all of that. If you have the plans to start a business and you want to self-fund, I recommend you start saving, you start putting the money aside, and then you figure out, okay, how much cash do I need to start a business? Make a spreadsheet, come up with that number, make sure that you save that amount, and then you document that amount as initial owner investment. And ideally, that initial owner investment, you'll be able to pay yourself back in spades over time because your business is going to be so great that you planned so well for, and your investment will far pay off. So make sure you take good records and plan for it.
I've been in business since mid-2023, but I've never taken an owner draw. Should I just start taking owner draws going forward and not worry about the past?
So if you've been in business since mid 2023, I'm curious if your business has been generating profit. If your business has, some businesses, depending on the type, don't generate profit right away. And if that's the case for you, then you know that's okay. You work towards that point where your business has the cash to pay yourself in owner's draws. I don't know if you've been taking salary. If you've been taking salary, that's a different story. I'm assuming you have not. Um, Now, if I would not work backwards when it comes to owner draws, you look at where's your business today, how much cash do you have in your business bank account, what are your upcoming expenses and revenue expectations, and set yourself up for success there and try to set yourself up to get on that schedule where you can again take those reoccurring personal draws on a regular basis. I would rather see people take $500 monthly regularly than take as much as you can today and then not have cash coming up. So that is my advice.
Wonderful. Well, we're a little past our time. I wanted to congratulate Kara for another wonderful webinar and to thank her for her time today. And again, if you have any other questions, you may reach out to us through our one-on-one advising. I put in a link in the of the intake in the chat. And we are happy to continue helping you in your business. Hope everyone has a great rest of their days. Thanks again, Kara.
Thank you. Bye.